Yeah. Good morning, one and all, each and every participants and the team at the screen, the learned faculty or the speaker of the day, C. Ankit Goyalji, the young and dynamic who has the deep knowledge on the subject, valuation and its many things in it. The moderator around us is the Sital Chog. The office team, Rahul is there with us to support us, and technology team is there. I, on behalf of the Valuation Standard Board of the Institute of Chartered Accountant of India, welcome you all to this series, the part three, Valuation Manthan. This goes every Sunday, 10 to 12. And today we are deliberating upon valuation compliances during the issue of the shares. You see, like valuation is has a different look at the different point of time, whether it is the business valuation or the financial strength or the many things to talk about. Those who are related with we as a professional or outside, like if we talk about the plant and machinery and the land and building, many things are not there within our ambit in the RVO also. In this system of the ICI, we have a two particular wings which take care of the valuation side for the professionals. One is the registered valuer organization RVO with us as on the ICI. Another in the ICI itself, there is a valuation standard board which carries so many good things for the guidance of the members. And naturally, if we talk about the opportunities around us in the valuation profession, so huge opportunity lies with, and we find our professional has to be geared up for the best of the knowledge to bring best from the best of the speaker around us. And today we have a CA Ankit Goyalji who will be taking us forward for the valuation compliance during the issue of this years. With this initial remarks, I welcome you all to again to this program, and hopefully at the end of the program you will find yes, you are more empowered with the knowledge, you are more strong with the many things which you have some kind of doubts. So with this marks, I welcome you all again. And now I'll request the moderator to brief about the Ankit Goyalji, the speaker, and then way forward, Ankit will be take it forward for the benefit of the each and every participants. Over to you, Sheetal.
Thank you so much, sir, for giving me the opportunity to act as a moderator for this session. Uh, I'm very much blessed to do this service for the organization, for the institute. And so today, our speaker is a CA Ankit Goel, who is giving us his valuable time for sharing knowledge on valuation standards. He is a practicing chartered accountant and holds a law degree. And he is a registered valuer for SFA and insolvency professional also. And he actively speaks on topics forensic audit, valuations, insolvency, on various events organized by the various prestigious firms like IBBI and ICI and other professional institutes. So we warmly welcome our speaker, CA Ankit Goel. So CA Ankit Goel ji, it's up to you now.
Thank you, Sheetalji. Thank you so much for the introduction. Thank you, Hansraj for taking this initiative on behalf of ICAI and the Valuation Standard Board of ICAI. Before I start, I must say that I think I was perhaps not even a chartered accountant since when I was noticing the work of Valuation Standard Board of ICAI, and rather before anyone else started work on valuation standards, it was the Institute of Chartered Accountants of India which took an initiative to build some local standards. And I believe that even today, the only Indian standards that we have are from ICAI, and the only Indian standards we have with respect to valuation under IBC are also from a body which has been promoted by ICI, that is the IIIPI. So I think that leadership goes back in time, and it's good to know that that is being continued under your leadership. So today's topic that we have is with respect to issue of shares, and issue of shares is something that's a very something that I think all of us as professionals are talking about, taking care of. Uh, the structuring, transaction structuring advisory that work, that when it comes to professionals, there again, the knowledge of what laws, what regulations are applicable with respect to the compliance requirement with respect to issue of shares is very important to understand, so that before the actual issue of shares, the professional, all of us as chartered accountants, can give our advice for the best and for the error free compliance for a company. And there I believe that understanding various compliances which are required at the time of issue of shares is very important. So like I would love to have an understanding, if possible, by the tech team. Can we have some kind of a like we will have the chat box where we will have the inputs from the participants. How can we get a feedback from them on what are their questions with respect to issue of shares, what are their queries, what is their experience with respect to such shares? Do they have a particular question, particular issues that we need to talk about? That will also be an icebreaker. And also, I think it goes along with my style of having an interactive session, because we have 2 hours with us. We should use it to the maximum. So can we have in like any way a response from the participants, maybe through the tech team, with respect to what kind of queries, what kind of issues do they face, or what kind of understanding they think we should talk about in today's session?
Sir, actually, this is the member participants are not directly connected to this Zoom meeting. So I will be sending the question meanwhile after a due session.
No
So actually,
worries.
this yeah,
So
they will be
my
hearing us that, but they won't be directly connected in on the live session. They would be sending the questions to me, and I will be sending directly to the Sheetal ma'am so that she can ask.
Got it. So, Sheetal ji and Rahul ji, maybe we can make a small change for this session, that we can keep talking about the relevant questions, maybe every 15-20 minutes, if that is possible, so that we can have it as an interactive session and not a monologue. So that will help. And in case, I will urge the participants, in case they can share their thought process, their queries, maybe we can also briefly talk about that. In the meantime, I'm starting with my presentation, but I will urge Rahul ji and Sheetal ji to keep sharing what the participants are giving us as inputs.
Yeah, sure, sir, sure.
So let us understand what are the regulations that affect us when we are issuing fresh shares to uh, any participant, when a company is issuing fresh shares. The first provision or the first act that is important is the Income Tax Act. Then we have the FEMA, and then we have the Companies Act. These are three that are required to be complied with, and they have provisions which seek some kind of compliance from the companies. What is the provision for under Income Tax Act? What is 5627B? That is the section that affects us under Income Tax Act. What is the objective of that Income Tax Act with respect to regulating the price at which the shares are issued? So the answer there lies in the idea that in Income Tax Act, this provision called 5627B was brought in because of the abuse that happened in many matters, because of a system that used to happen, that a lot of money used to come into companies as capital through entry operators, and there was little that the income tax department could do, because they did not have any provision to tax the company and they were not able to collect the tax from the people who were able to, or who were making the investment in the shares for a value which is less than the uh, fair value as per the Income Tax Act. So the idea then became that for resident investors, the company will get money, and whenever the company will get money at a valuation which is more than the fair market value, then the company will have to pay tax on it. That is, we will look into that provision in detail. But the objective is very clear: to tax the money or tax that amount which is received by the company over and above the fair market value or fair value of the company. Now, here, the thought process and my thought process is, and my personal opinion is that in case an investor feels that there is value in investing in a company at an X rupee value, then, in my opinion, it becomes a anti-investment, or rather anti-ease of business requirement. And when we ask the company to justify that this is the value of your share, so imagine a valuer, an independent professional, or a chartered accountant, or a merchant banker trying to determine the value of a company, when the company and the investor have agreed on a value at which the fresh issue of shares will happen. So that is something that we will discuss in detail. Then comes FEMA. What is the objective under FEMA? What does FEMA overall as an objective have with respect to uh, issue of shares? FEMA, the thought process is that the FEMA regulations would like to protect Indian assets, or rather, foreign exchange management is also part of the deal. So, there, the thought process is from the government of India that the Indian shares or shares of Indian companies should not be allotted to foreign or non-residents without at a price which is less than the fair value of those shares. And why is that important? So that it is should not happen that the foreign owners or non-residents get the Indian shares at a value which is less than their fair value. That is the objective of controlling that regulation. Lastly, with respect to Companies Act, it is important for us to understand that Companies Act controls the valuation, or rather regulates the valuation of shares when the shares are allotted under a private placement. And there the objective is to, of course, in my opinion, the objective is to safeguard the existing shareholders, existing stakeholders, and make sure that the value that is realized from the private placement is more than the value of the shares, and the existing shareholders do not get diluted beyond what they should ideally be diluted for through a private placement of shares. So that is the objective. So FEMA, Companies Act, I'm very much convinced with the objective of the government of India with respect to regulating the price at which the fresh issue of shares happens. But under Income Tax Act, where the idea is to tax the additional amount, uh, uh, the idea is something that is sometimes it works against the company. So let us understand what is the need for valuation of companies. So we have talked about Companies Act. Companies Act, the provisions refer to registered valuer. So the valuation is required to be done by a registered valuer. Issue of sweat equity shares under Rule 8, that is the Companies Act. Again, a registered valuer is required to value. Fair market value of shares issued by the company under 5627B. This is again something where merchant banker or chartered accountant, we will talk about which securities a chartered accountant can value here. And then lastly, we talk about the FEMA regulations. So these are the regulations that are applicable with respect to issue of shares. The sections that are important under the Income Tax Act with respect to fresh issue of shares and with respect to transfer of shares as well involve 50CA, 56 to 10, 56 to 7B. 56 to 7B is at the center of fresh issue of shares. 50CA and 56 to 10 more or less talk about transfer of shares. Rule 11U, 11UA, 11UAA, 11UAC, and 11UAD These are the rules that then are important with respect to the understanding of the computation of FMB. 56 to 7b. 56 to 7b goes on like this. Talks about where a company, not being a company in which the public are substantially interested, we will follow on and understand what are the companies in which the public is not substantially interested, which are not under the ambit of this section. Receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value of the shares. So that is what the government wants to tax. What is it taxing? The aggregate consideration received for such shares as exceeds the fair value of the shares. Then there's a proviso that this clause shall not apply where the consideration for issue of shares is received by a venture capital undertaking from a venture capital company or a venture capital fund or a specified fund by a company by a company from a class or class of persons as may be notified by the central government on its behalf. And central government has notified startups which are registered under 56(2) with respect to this provision. Then it goes on to say, provided further that where the provisions of this clause have not been applied to a company on account of fulfillment of conditions specified in notification issued under clause 2 of the first proviso and such company fails to comply with any of those conditions, then again the valuation or the taxation will happen at the time of that failure. So in case you have this proviso and you have a class of persons who have been notified, if at any point in time they are not able to meet the required compliances, then they stand to get taxed. Then it says in explanation that for the purpose of this clause, the fair market value of the shares shall be the value as may be determined in accordance with such method as may be prescribed. And where has this method been prescribed? It has been prescribed in Rule 11UA. Or as may be substantiated by the company to the satisfaction of the assessing officer based on the value on the date on issue of shares of its assets, including intangible assets being goodwill, know-how, patents, copyrights, trademarks, licenses, franchises, or other business or commercial rights of similar nature. So one option is to go to the Rule 11U, give the AO a valuation report, or compute the value based on the formula provided therein, or you explain the AO that the value is what we are saying was, and there is no taxation here. So these are the two options. Now, when we talk about income, when we go ahead and understand the definitions which are part of these provisions, the specified funds. What is the specified fund? Specified fund was talked about here, where we talked about VC undertaking, venture capital company, venture capital fund, or a specified undertaking. The specified undertaking or specified fund here, specified fund means the AIFs, which are category 1 or category 2 AIFs, they are, of course, made part of this provision. And then trust, venture capital company, and all these are defined here. Company in which the public are substantially interested. This is defined in section 218, where it is said that the company is said to be a company in which the public are substantially interested, where the company is owned by the government or the RBI, and where they own not less than 40%. Then it talks about a company which is registered under Section 25 of the Companies Act. That is the non-profit companies or not-for-profit companies that we talk about under Section 25. Then if a company is having no share capital, then again, that company is excluded. Then if it is a mutual benefit finance company, if it is a company where shares not being shares entitled to fixed rate of dividend, carry not less than 50% of the voting power, if it is a company which is not a private company as defined in Companies Act, and the conditions specified either in item A or B are fulfilled. So what is item A? So one, it should not be a private company. It should be a limited company, a public limited company. Then what is either of the two conditions? Either it is listed on a recognized stock exchange on the last date. That is one provision. And B is that shares in the company, not being shares entitled to fixed rate of dividend, carrying not less than 50% of the voting power, have been allotted unconditionally to or acquired unconditionally by, and were throughout the relevant years beneficially held by the government or a corporation established by a central, state, or provincial act, or any company to which this clause applies, or any subsidiary company to such company if the whole of the share capital of the subsidiary company has been held by a parent company or their nominees. So either it should be a government-run public company, or it should be a listed company where the company is listed as on the last date of the relevant financial year, relevant previous year. That is where it does not become a public company, does not become a company in which the public is substantially interested. So all private companies uh, will become uh, companies in which the public are substantially public are not substantially interested. And with respect to not a private company, the additional conditions have to be fulfilled, where either it should be listed or it should be a government-run company. That is when this provision gets affected. 56 to 7B, was a change in the budget, or a proposed change in the budget, where initially it was discussed that the this part, that is from any person being a resident, here the being a resident is now proposed to be removed, and the change was earlier effective from 1/4/2023, but it has now been changed, and it was now proposed that it will be effective from 1/4/2024. And I understand that there must be some feedback from these stakeholders, by saying that when you say that when the money comes in from a non-resident to the Indian company, then how will you set things up? Because you're then having a scenario where under Income Tax Act, you're saying that if a company receives more money than the fair value of the shares, then the additional amount is taxable. On the other side, under FEMA regulations, you say that if the money comes in from a non-resident to a company for issue of shares, against issue of shares, then the value cannot be less than the value of shares. So under two acts, you're having a provision, and you're compulsorily making something taxable. And that is something that might affect a lot of companies. Maybe that was the thought process in deferring this. So that's 56 to 7B. Coming to valuation under Rule 11UA, let's understand what all do we talk about here. So first of all, we say, let's understand 11U. 11U talks about meaning of expressions used in determination of fair market value. And it says, for the purpose of this rule and 11UA, balance sheet in relation to any company means for the purpose of sub-rule 2 of Rule 11UA. What is sub-rule 2 of Rule 11UA? Sub-rule 2 of 11UA talks about sub-rule 1 talks about sub-rule 1 talks about valuation in normal circumstances. Sub-rule 2 talks about valuation of shares under 56 to 7B. So when the provision under 11U specifically starts with 11UA subpart 2, then we are looking at valuation with respect to issue of equity shares for fresh issue of shares, right? That is what we're looking at. So here, when we look at this and we see that, okay, the balance sheet for sub-rule 2 of 11UA is the balance sheet of such company as drawn up on the valuation date, which has been audited by the auditor of the company appointed under Section 224 of the Companies Act, and where the balance sheet of the balance sheet as on the valuation date is not drawn up, the balance sheet drawn up as on the date immediately preceding the valuation date, which has been approved and adopted in the AGM of the shareholders of the meeting. So with respect to fresh issue of shares, the balance sheet is either the balance sheet drawn on the date of the issue of shares, or if that is not drawn, then you refer to the previously last audited balance sheet available, which has been already presented before the AGM. So that's the meaning of the balance sheet for this purpose. For the purpose of 11UA, with respect to other cases, the balance sheet is basically required to be drawn on the valuation date, which has been audited by the auditor of the company appointed on the law relating to Companies Act in force. And in relation to a company not being an Indian company, then there the balance sheet can be done, and then the auditor is required to be appointed based on the provisions of that law, that act. So valuation date then becomes an event here, that you need the balance sheet as on the valuation date to compute this value which we're talking about here. We will then come to the know that where do we need this balance sheet. So let us go forward and see where we need this balance sheet. But the meaning of balance sheet is clearly mentioned here. Merchant banker is defined as a category 1 merchant banker. Quoted shares of securities, then talk about how the quoted shares and securities should be recognized in the stock exchange with regularity from time to time, and where the quotations are on the current transaction. So this is how the quoted shares or securities have been defined. Recognized stock exchange has been talked about. Registered dealer has been talked about as somebody who is registered with the sales tax law. Registered valuer has been referred to as the valuer who is registered under the Wealth Tax Act, although we will go forward and I will tell you how the registered valuer is seldomly mentioned. Securities, unquoted shares and securities, valuation date, all this is mentioned in the definitions. Then, of course, let's understand the structure of Rule 11UA. 11UA talks about 11UA subpart subrule 1A talks about valuation of jewelry. Then we have B, which talks about archaeological collections. C, which talks about valuation of shares and securities, where we talk about quoted shares, unquoted equity shares, and unquoted other shares and securities. Valuation of shares under section 5627B, then in 11UA subrule 2. Part A talks about formula based approach, and part B talks about merchant banker DCF. So we'll go through these provisions, these rules in detail. But as we have already talked about, 11UA subrule 2 is only applicable where the valuation of shares is required under 5627B, and only applicable where we are talking about equity shares. In many circumstances, the investment that comes in, a fresh issue of shares that happens, is through convertible preference shares or convertible debentures. In those circumstances, the 11UA subrule 2 is not applicable, and we then go back to 11UA 1C to then value those shares, and there again we have a provision or a system to value those shares. With respect to 11UA 1, in case a company which is where you're computing the adjusted book value method, if it has jewelry, then the jewelry is required to be valued based on this method. But in case you are issuing fresh shares, and you're issuing fresh shares to an outsider, there again this provision is something that we will just read with respect to how these shares are valued, and then come back to these provisions to see how they affect us. So these are the archaeological collections, and then we talk about valuation of shares and security. So part A talks about the fair market value of quoted shares and securities shall be determined in the following manner. It says that if the quoted shares and securities are received by way of transaction carried out through any recognized stock exchange, the fair market value of such shares and securities shall be the transaction value as recorded in such stock exchange. If such quoted shares and securities are received by way of transaction carried out other than through a recognized stock exchange, the fair market value of such shares and securities shall be the lowest price of such shares and securities quoted on any recognized stock exchange on the valuation date, and the lowest price. So in case it is quoted, then not much problem, right? In case it is a quoted share and you have purchased the shares through the market, then that is the price. In case you have purchased or you have got some shares or you have issued some, you've got some, you have been given some shares, then those shares will be valued at the lowest price which that share is trading at. That's how the valuation is happening here. Then there's a formula. So this is one part where is it? Where is this applicable? This is applicable where the fair value of quoted shares and securities is valued like this. The fair market value of unquoted equity shares shall be the value on the valuation date on which the unquoted equity shares are as determined in the following manner. So what are we doing here? We're adjusting the book value. But is this applicable to fresh issue of shares? No, this provision is not applicable to fresh issue of shares because this is only applicable to for transfer of shares under 56 to 10. With respect to fresh issue of shares, we have a provision here, which is the part 2 or sub rule 2 of 11 UA, which says that notwithstanding anything contained in sub clause B of clause C of rule 1. So what are we talking about? B of clause C or clause sub rule 1. So in case you go back to sub rule 1, here we are talking about C and we're talking about CB, right? Sub rule 11, rule 11 UA 1 CB. That is what is being overridden by 11 UA sub rule 2 here. So what are we doing here? We are looking at now, this is overridden. And then we say that notwithstanding this, for the purpose of subclause 1 of clause A of explanation to clause 7B of 2 of 56. So 56 to 7B, clause A subclause 1. What was 56 to clause A subclause 1? 56 to clause A subclause 1 was with respect to as may be determined in accordance with such method as may be prescribed. So this is what was here and what has been talked about in the rules with respect to this provision. With respect to this provision, it has been said here that the valuation that shall be the value, the fair market value of unquoted equity shares shall be the value on the valuation date of such an unquoted equity shares as determined in the following manner under clause A or clause B at the option of the assessee. So A or B is a choice here. For what? For only unquoted equity shares, not for preference shares. So the fair market value of unquoted equity shares is equal to A minus L divided by PE into PV. What is A? Book value of the assets in the balance sheet as reduced by the amount of tax paid or reduction or collection at the source or an advance tax payment as reduced by the amount of tax claimed as refund under the Income Tax Act and any amount shown by the balance sheet. So what you're doing, you're only adjusting the balance sheet to the book value for what all? For maybe the refunds that you're claiming from the income tax department, for the liabilities that you have towards the Income Tax Act. So we're talking about the provisions for income tax, provision for income tax created in the balance sheet, created in the books of accounts. And on the other side, maybe some refunds which are receivable. And you then talk about the unamortized deferred expenditure, which does not represent the value of any asset. This is the only adjustment that you make in the assets. In the liabilities, you basically take all the liabilities, excluding the paid up capital in respect of equity shares, the amount set apart for payment of dividends and preference shares, reserves and surplus, any amount representing provisions for taxation, any amount representing provisions for meeting liabilities other than a certain liabilities, and amount representing contingent liabilities. And that is what you do. You then look at total amount of paid up equity share capital as shown in the balance sheet and the total paid up value of such equity shares. So when you do all this, you get a value which is sometimes even lesser than the book value which is prescribed in 11 UA Part 1. So interestingly, if the Income Tax Act is creating a provision here this provision where they are saying that the fair market value of unquoted equity shares for the purpose of determining that what should be the minimal value for the transfer of your shares for us to levy tax. What is the tax amount that is calculated here? The tax is basically calculated that if you are transferring shares at a value which is less than this value, then there is taxation, right? That is the idea under 56(2)(10) or under 50CA. That is where the taxation comes in for the transfer of shares. But here, what is the premise of taxation and what is the valuation of taxation? It is on the other side where you say that if you're getting more money as compared to the value of shares, then we want to tax the amount that you're getting more than as compared to the market value of the transaction. So here the value will is kept to be on the lesser side. So you're not even allowed to change the value of circle rate of properties owned by the companies. You're not even allowed to change the values with respect to archaeological assets, etc., etc. The book value is what you can claim here. So this provision or this part of the provision is almost never used, because if you talk about book value, unless and until the book value is more, you will never be able to use this provision. So what you are able to use, you are able to then you have to come to part B. What does part B says? Part B says the fair market value of the unquoted equity shares determined by a merchant banker as per discounted free cash flow method. And this is the provision that is used in most cases for the valuation of unquoted equity shares. So now this is what I wanted to say with respect to unquoted equity shares. Let me now come back and talk about valuation of uh, other securities. So when we talk about valuation, this is what we're talking about. Now coming to the part where you're talking about valuation, part C. So this is the part C, which says valuation of shares and securities, which says that the fair market value of unquoted shares and securities other than equity shares in a company which are not listed in any recognized stock exchange shall be estimated to be the price it would fetch if sold in the open market on the valuation date, and the SSE may obtain a report from a merchant banker or an accountant in respect of such valuation. So in my opinion, when a company issues convertible preference shares, or if the company issues convertible debentures, then it is this provision that gets activated, and it is based on this provision that maybe a chartered accountant or a merchant banker can issue a report. And also, there is no restriction on using only discounted cash flow method. One can always use other methods as well with respect to this provision. So at this point in time, I will request maybe Rahul ji and Sheetal ji to share in case there are any questions, there are any queries at your end or from the participants' end.
Yes, see, Gurji, we have a set of questions like coming from member side. So, I want to ask one question. What are the modes of valuation compliances?
Modes of valuation compliances. Okay. Modes of valuation compliances would be a valuation report, as we talked about under 11 UA. We can also then compute the book value of the shares as is prescribed under this 11 UA method. So I think that was the question, but I would like to understand more on, maybe you can clarify the question, the participant can clarify the question further as well.
Like in what ways like valuation compliances we need to do? I think that is the concern of this question. Like
Basically, with respect to the income tax part that we have just talked about, we are sure that with respect to whenever a company is issuing equity shares at a premium, and the equity shares at a premium are being issued to a resident, then there is a requirement for a merchant banker to give a valuation report, and the income tax says that the merchant banker's computed fair market value can be used as the barometer to determine if there is any taxation liability on the company. So that report is required to be taken, kept by the company in its records, that in case there is an assessment in future, then that report can be used. On the other side, as we talked about, that in case of non-equity shares, in case we talk about preference shares, in case we talk about convertible preference shares, convertible debentures, other securities, There, the valuation can still be done by a chartered accountant, and that report can be kept by the assessee for future. So this is under Income Tax Act. We will keep talking about FEMA and Companies Act over time.
And one another question is, what are valuation requirements for share transfer from NRI to resident India of unlisted companies?
So you come to FEMA and we'll talk about that. Any specific question from the participants with respect to income tax compliances, Rule 11 UA compliances? Please let us know. And I believe in case something like this, some question comes in or some query comes in, then I think we can also discuss that.
Okay, sure.
So that's 11 UA, and that's the valuation which is required under 5627B. And going forward, there is an 11 UAA, which does not really affect fresh issue of shares per se. But yes, it does say that for 50 CA, for what does 50 CA say? 50 CA says that in case somebody is selling shares of a company, then in that case, the value of that company or the sale consideration can be replaced with the fair market value of the shares, and the fair market value of that shares is computed as per 11 UA sub rule 1. Then for the purpose of section 28 of the act, where we say that the inventory can be sold, there again there is a provision. I think I can skip that, not being very relevant. uh, of course, basically we then say that there are some class of persons for the purpose of clause 11 of the proviso to clause 10 of subsection 2 of section 56. There again the provisions of clause 10, it said that they will not apply to certain cases. So these are certain areas where these provisions are not applicable. Uh, then, of course, there are some prescribed classes of persons for the purpose of clause 11 of proviso of 10. I again would skip this because the idea is to concentrate on issue of shares and that valuation today. So I think I can keep this a miss. So with respect to 11UB, again, we're talking about valuation of shares in certain cases, but then again, it is not with relevant. So let me just come to 11. This is 56. 56 is with respect to transfer of shares again. So let's understand some case laws on this subject before we move on to the FEMA regulations, FEMA compliances. Karmic Labs Private Limited versus ITO, it's an ITAT Mumbai judgment. Here the assessee has it was basically decided by ITAT Mumbai that the assessee has the choice to choose a prescribed method for ascertaining the market value of the shares transferred. If the assessee has chosen one method of valuation provided under Rule 11 UA, the AO has no power or jurisdiction to change that method to another method. So they had then referred to various judgments with respect to this matter. Sinistan Entertainment Private Limited versus ITO, their ITAT Delhi judgment. So where 5627B Rule 11 UA has been talked about. Here it says, the judgment says that the AO has no jurisdiction to substitute his own value. He also cannot question the commercial wisdom of the assessee and its investors. The DCF method is based on projections. The AO cannot fault the valuation on the basis that the real figures don't support the projections. Also, the fact that independent investors have invested in startup proves that the FMV as determined by the assessee is proper. The shares have not been subscribed by any sister concern or close related person, but by an outside investors by Rakesh Jhunjhunwala, Radhakrishan Damania, who are one of the top investors and businessmen of the country. And if they have been seen certain potential and accepted this valuation, then how AO or learned CIT appeal can question their wisdom. The investors like these persons will not make any investment merely to give dole or carry out any charity to a startup company, albeit their decision is guided by business and commercial prudence to evaluate a startup company like Assessi, what they can achieve in future. So the idea is that these are judgments where it has been decreed that the AO should not get himself involved in the valuation business. NUB Multi-Trade Private Limited versus ITO is an IT80 Jaipur judgment, and here it says that the IT80 allows SSC's adoption of land FMV while arriving at share valuation and revenue misconstrued Section 5627B. So here Jaipur IT80 deleted the addition under Section 5627B for assessment year 14-15 towards alleged excess share premium received by the SSC, a private limited company engaged in the construction of flats and trading in shares over the fair market value. To substantiate the premium of rupees 190 per share, the SSC submitted a valuation report of registered valuer as per Rule 11UA. However, while arriving at such share valuation, the land was valued at an FMV of 2.93 crores by the valuer instead of balance sheet value of 1.3 crores, which was rejected by AO, who made the impact addition applying DCF method of valuation. So here again, then basically this was decreed that the land FMV is permitted under 5627B. Agro Portfolio Private Limited was a 1980 Delhi judgment where the valuation report of the merchant banker was rejected. And this is an important judgment that in this case, the department pointed out to the disclaimer clause appended by SPA Capital Advisors and then talked about DCF and it's talked about how the DCF method here is being worked out on a reverse calculation basis or a reverse engineering process. And in preparing the final report, SPA has relied upon and assumed without independent verification the truthfulness accuracy. So SPA or whatever the valuer was here did not go through or did not maybe perform or write in the report about the processes that they have performed with respect to verification of projected data or bringing in clarity on the expected data. And the appraisal of this long disclaimer clearly shows that the merchant banker did not do anything reflecting their expertise except applying the formula to the data provided by the SSC and so on. So this is how they then said. So key points from the IT80 were that the beta was taken as 1 when the company was in losses from past few years, where the sector-specific study has been carried out to reach the rate of return of growth, what will be the terminal growth. So all these provisions were captured in the case law. And it was basically the valuation report it was said that the valuation report is not good enough, based on which now a lot of assessments are happening where the AO attacks the valuation report and says that the valuation report is not right, and therefore I am making this addition with respect to 5627B. So before we go to FEMA, any other queries, any other questions that have come from the participants? Sheetal ji, Rahul ji.
Yes, Ankit Gurji, we have one question. Companies are also issuing various class of shares, class A and class B, for example, which have a varying rights, especially with respect to divided and economic rights. How do we value them under 11 UA?
So when companies are issuing class A or class B shares, and these are class A or class B equity shares, then the Income Tax Act and 11 UA is silent about those differential rights. And therefore, the only way we can bring in or capture the different values available to these shareholders will be with respect to understanding what are these differential rights. To understand what are the differential rights that are normally available to the shareholders, we understand that one, there can be a differential right with respect to voting participation in the decisions of the company. There, one can say that when DCF model is applied, we can apply for a discount or a premium with respect to the control, or rather the discount for lack of control, or control premium on certain shares where the voting is there or voting is not there. So in case we say that, okay, using DCF, we compute the total enterprise value as, let's say, 100 crores. That 100 crores, then reducing debt of maybe 50 crores, we have an total value available to equity shares of 50 crores. Now, when we divide this 50 crores amongst the equity shareholders, we can use a Black-Scholes model, we can use other option pricing models, where we can give a higher value to those shares which have a superior voting right as compared to a deficient voting right. Then there can be other differential rights that are available to certain equity shareholders with respect to maybe a higher dividend, a higher liquidation preference. So that is the method that we apply to bring a value at. So these are extensions of DCF, option pricing models, to understand the additional value, or the distribution of value amongst the equity shareholders when we are applying DCF model to calculate the value. So let's go ahead and now talk about regulations under FEMA. I think income tax mostly should be clear to us. We as chartered accountants can still do valuations for preference shares, convertible preference shares, debentures, etc., other securities that are issued by the company under 11 UA sub rule 1. With respect to equity shares, whenever they are issued, we will have to go to a merchant banker. When the when we go to a merchant banker, at that point in time, the company will have to give projections or projected financial statements, because only a DCF can happen with respect to company. And with our expertise as income tax consultants, with understanding the scrutiny cases, understanding past experiences that we have had in getting assessments done, we can then make sure that the valuation model that the company is sharing with the merchant banker is closest to its actual achievability with respect to the next 2 3 years. Because normally when the income tax department opens up your scrutiny to assess your income, it will be within that time period. So that time period, if the projections are close to what the actual numbers are, then you will be able to defend that report a little better. The report then has to be complete. The report should not have too many disclaimers. The beta should be supported. The terminal growth rate should be supported. All that should be there as part of your report. It should be a good quality report. That is what is then required when we talk about the requirement for getting the assessment done under Income Tax Act without getting an addition made, right? So under FEMA, the first provision is foreign exchange management, transfer of issue of security by a person resident outside India, regulations 2017. Then you have a master direction with respect to foreign investment in India, master direction with respect to reporting under Foreign Exchange Management Act, and draft foreign exchange management, non-debt instruments, overseas investment rules 2021. These are the various valuation requirements under FEMA. Coming to that provision where we say that issue of shares. So this is that provision. Clause 8.1 of the regulations talk about capital instruments issued by a company to a person resident outside India. We just talked about 56 to 7B, where the provision was applicable only and only where the resident was involved. But of course, future we will see a non-resident also getting involved. But right now, presently, throughout this financial year, coming financial year also, or this financial year that we are in 2023, 24 also, even that is what is going to be applicable. FEMA provisions talk about now coming to the structuring. There can be a scenario where both income tax and FEMA regulations require you to do a valuation. What would be that premise? That premise will be where maybe you're issuing shares or doing an issue of shares where maybe you're allotting shares to a non-resident as well as a resident. In case you do that, then maybe for the transaction with respect to the resident, you need valuation under Income Tax Act, and for the transaction that you're doing with a non-resident, you need valuation under the FEMA Act. So then there is a cause, or there is a possibility that the valuation is required under either of these acts or both of these acts, where a combined valuation or a common valuation should happen, because you don't want to have very different valuation reports. So there, in case of income tax and FEMA, What does FEMA say? FEMA say you can get a valuation report done from a chartered accountant, a SEBI merchant banker, or a cost or a practicing cost accountant. So if you're issuing maybe non-equity shares, you can go to a chartered accountant and get this certificate for FEMA purposes as well as income tax purposes. In case you are issuing equity shares, you can maybe get a certificate under FEMA as well as Income Tax Act from a merchant banker. So that one certificate will meet both the obligations or meet both the requirements. What is the provision here? So the provision is that the price of capital instruments of an Indian company issued by it to a person resident outside India should not be less than the price worked out in accordance with the relevant SEBI regulations in case of listed Indian companies. The valuation of capital instruments done as per internationally accepted pricing methodology for the valuation on an arm's length basis duly certified by a CA, SEBI registered merchant banker, or a practicing cost accountant in case of an unlisted Indian company. So, what is missing here? This provision is an older provision. So, since this provision or later, the registered valuer concept has also come in under the Companies Act. And there, what has happened is that the registered valuers under Companies Act are then given that mandate. So that mandate is missing here. So in case you have a combination where you're required to issue shares under the Companies Act under preferential allotment, and you're also issuing shares to a non-resident, you will end up having two valuation certificates, one from a chartered accountant or a merchant banker or a cost accountant, and the other from a registered valuer. So that issue will come in, and we will talk about that clutter and how we can do something to remove that. So SEBI guidelines with respect to a listed company, because here, in case you read this again, the FEMA guidelines, it says that in case of listed companies, you have to follow the SEBI guidelines. SEBI guidelines then talk about uh, where the regulations apply, these issue of capital and disclosure requirement guidelines. And then they talk about how the valuer is a person who is registered under the Companies Act as per the SEBI regulations. And that is basically um, the rights are required to be valued. So, SEBI guidelines in case of listed companies talk about disclosure to shareholders, and wherever the issuer, in addition to the disclosure required on the Companies Act, also disclose the following in the explanatory statement. What is he supposed to explain? Where the specified securities are issued on a preferential basis for consideration other than cash, then the valuation of assets in consideration for which the equity shares are issued need to be talked about here. And then we talk about price of frequently traded shares. So SEBI guidelines differentiate between frequently traded shares and others. So for frequently traded shares, they talk about they then divide that. They say that for equity shares of the issuer, if they have been listed on a recognized stock exchange for a period of 26 weeks or more, then the price of the equity shares will be the average of weekly high and low for the 26-week period or the 2 week preceding the relevant date. It will be uh, uh, higher of the following. With respect to shares which have been trading for less than 26 weeks, there the price can be the IPO price or the price which has been the weekly high and low, the average of the weekly high and low during the period of the equity shares, and of course, lastly, the 2 week period. So this is how the pricing of frequently traded shares is required to be done under SEBI guidelines, which will then become a reference point for the FEMA certification or the FEMA issue of shares. And of course, the traded turnover on any recognized stock exchange during 12 calendar months preceding the relevant date is at least 10% of the total number of shares of such class of shareholders. The definition of frequently traded shares. Netted average number of total shares of such class of the issuer shall represent the total number of shares. The issuer is permitted that where the share capital of a particular class of shares of the issuer is not identical throughout such period, then the weighted average number of total shares of such class have to be taken. So this is how the frequently shares have been. Now, coming to infrequently traded shares. Infrequently traded shares, it says that the issuer shall take into consideration the valuation parameters, including book value, comparable trading multiples, and such other parameters as are customary for the valuation of such shares of such companies, provided that the issuer shall submit a certificate stating that the issuer is in compliance with this regulation obtained from an independent valuer to the stock exchange where the equity shares of the issuer are listed. So this is the pricing of infrequently traded shares. And then, of course, in case of convertible capital instruments, the price conversion formula of the instrument is required to be determined upfront, and the price at the time of conversion should not in any case be lower than the fair value worked out at the time of issue of such shares. This is the provision. And then we talk about transfer of shares and so on. And transfer is something that we're skipping today. So with respect to fresh issue of shares, to conclude the FEMA provision, we are saying that we're looking at a provision where the valuation certificate issued by the chartered accountant, SEBI merchant banker, or a practicing cost accountant can be used for the purpose of an unlisted Indian company, and for the purpose of a listed Indian company, the provisions stated in the SEBI compliances can be followed so that the so that compliance is ensured for under FEMA. Any questions with respect to the FEMA provisions for issue of fresh shares? Any questions, Sheetalji, from any of the participants?
Not with respect to mm, FEMA specifically, but we have a question 111 UA. Should I ask?
Yeah, please go ahead, please.
How to consider deferred tax assets and liabilities in Rule 11 UA evaluation?
So when we talk about fresh issue of equity shares, there the deferred tax calculation is something that is, as we talked about, is something that gets captured in the discounted cash flow method. Deferred tax calculation is more of an accounting system. When we do a DCF analysis and when we are computing cash flows, we are we are interested in the cash flows. So in case we are talking about taxation cash flow, then we try and compute the future tax liability of the company based on the adjustment of the income tax depreciation available under section 32 of the Income Tax Act. And based on that, then we compute the total tax outgo and the cash outgo uh, with respect to taxation. So the deferred tax is not really coming into the picture with respect to understand future cash flows. When we come to the book value method, which has been prescribed in 11 UA subrule 2 part A, which I said is very rarely used. There again, my thought process is that the deferred tax calculation will be removed from the provision, because deferred tax, if it is a liability, does qualify as a provision for income tax. And in case it is an asset, it is something which is a deferred expenditure, or it is not a realizable asset. So we can exclude that from the computation of the value which we are trying to compute. So I think this is something that we have talked about. So, sorry. Yeah. So going ahead, we're looking at this is the price of capital instruments of an income transferred by a person resident outside India. I will just skip this part. And yeah, yes, please. Is it okay now? Is it better? Let me know. Let me know if it happens again. I am all connected with everything, but yes, there was, I think, electricity cut a while back, so that might have interrupted some things, but it should be okay now. Let me know if it happens again. So investment in an LLP, I think I will skip this part as well, but then we will talk about issue of shares, concentrate on that. Of course, FCGPR compliance does require that any issue of equity shares should be reported to FEMA, and then even bonus or rights issue uh, are required to be reported to FEMA under FCGPR. IPO and qualified institutional placement is not, of course, part of that process. And in case of foreign venture capital investors, there again the pricing guidelines are not applicable for such investments, and there the valuation certificate is not insisted upon. With respect to draft regulations for overseas investments, there again there have been certain changes that have been proposed that in case there is outward remittance from an Indian company to purchase shares abroad, then for that they have now talked about a registered valuer uh, that he can do the valuation. So that's FEMA. If there are no questions on FEMA, then I will move on to the Companies Act. Now, with respect to Companies Act, when we talk about 62(1), Section 62(1), 62(1) is titled or headed further issue of share capital and says where at any time a company having a share capital proposes to increase its subscribed capital by issue of further shares. Such shares shall be offered to any persons if it is authorized by a special resolution, whether or not those persons include the persons referred to in clause A or B. A or B talks about who all? A or B talks about existing shareholders and talks about employees, sweat equity shares and all that. Either for cash or for consideration other than cash, if the price of such shares is determined by the valuation report of a registered valuer, subject to compliance with the applicable provisions of Chapter 3 and any other conditions as may be prescribed. So the requirement to get the valuation certificate from a registered valuer originates from the Companies Act itself, not even from the rules. Then when we come to the rules and we look at Rule 13, and we look at Rule 13 of Companies Share Capital and Debenture Rules 2014, here the issue of shares on a preferential basis has been talked about, and it says that 13.1 talks about that for the purpose of clause C of subsection 1 of section 62. Let's come back. C1, 62.1c is what we just read. It said that for the purpose of clause C of subsection 1 of section 62, if authorized by a special resolution passed in a general meeting, shares may be issued by any company in any manner whatsoever, including by way of a preferential offer to any persons, whether or not those persons include the person referred to in clause A or B of subsection 1, and such issue on preferential basis should also comply with conditions laid down in section 42 of the Act. Then it says that provided that in case of any preferential offer made by a company to one or more existing members only, the provisions of sub-rule 1 and proviso of sub-rule 3 of rule 14 of companies prospectus and allotment of security rules shall not apply. Then it is provided further that the price of shares to be issued on a preferential basis by a listed company shall not be required to be determined by the valuation report of a registered valuer. So they now said that listed company will not be required to get a valuation report of a registered valuer. Then it gives an explanation and says that the expression preferential offer means an issue of shares or other securities by a company to any select person or group of persons on a preferential basis and does not include shares or other securities offered through public issue, rights issue, employee stock option scheme, employee stock purchase scheme, or any issue of sweat equity shares or bonus shares or depository receipts issued in a country outside India or foreign securities. Then it says the expression shares or other securities means equity shares, fully convertible debentures, partly convertible debentures, or any other securities which would be convertible into or exchanged with equity shares at a later date. So this is how This rule has been stated. Going forward, it says whether the preferential offer of shares or other securities, where the preferential offer of shares or other securities is made by a company whose shares or other securities are listed on the recognized stock exchange. Such preferential offer shall be made in accordance with the provisions of the Act and the regulations made under SEBI, made by SEMI. And if they're not listed, the preferential offer shall be made in accordance with the provisions of the Act and rules made thereunder. When it says the company shall make the following disclosures in the explanatory statement, it will talk about the basis on which the price has been arrived at along with the report of the registered value. So this will go in as an explanatory statement to the notice of the general meeting. Where shares or other securities are to be allotted for consideration other than cash, then the valuation of that consideration should also go. Then it says that the price of shares or other securities to be issued on preferential basis shall not be less than the price determined on the basis of valuation report of a registered value. So the registered value is giving a value, and based on that value, you're then saying that you can give a preferential or issue a preferential issue only for a value which is higher than what the registered valuer has given in his report. This is how this works. So now coming to overall structuring, I think the Companies Act is pretty clear with respect to the requirement to get valuation done wherever there is a private placement of shares and so on. So Companies Act says you get a market value, you compute the market value by an RV, a registered valuer under Companies Act. Income Tax Act says that you can get it done from a merchant banker or a chartered accountant, depending on what you are getting valued or what you are allotting. FEMA says that market value implied by given by CA, MB, CMA, they can give it. So with respect to if you're doing only a fresh issue of shares to a resident under private placement, then you are requiring a valuation from an RV plus a CA or a merchant banker. In case you're issuing it to a non-resident, then you can actually skip the Income Tax Act requirement and rather choose between a CA, merchant banker, or a CMA. In case you're issuing shares to a resident as well as a non-resident, then again you will have to choose between a CA or a merchant banker for that valuation report. Then, in case you are issuing shares to the same people in a combined transaction, sometimes you have a structure where you kind of have a system where you are issuing shares to a resident as well as a non-resident. In that circumstance, again, you might be ending up paying tax on certain small part or amounts where you have taken more money for a share consideration under Income Tax Act. So income tax might require you to pay some tax because FEMA would say that you should always get more money than the value of the shares given to you. Companies Act also says that for the valuation that has come in, you should always have more value as compared to that value. So this is what is the present regime for valuation requirement, valuation provision requirement under Companies Act, Income Tax, FEMA. So with respect to this provision or with respect to this discussion, any other questions, any other issues that are there, Sheetalji, that you can think of, you can bring up, I'd be happy to talk about. So please let me know, yeah.
We have one question.
Yeah.
In case of optional issue of preference shares, what will be the price for issue when the option is exercised?
So when we talk about optional issue, as we read in FEMA regulations, the valuation is the FEMA regulations say that when there is an optionally convertible share, then the conditions and the clauses or the pricing at which the conversion will happen should be very, very clear and should be visible. And that is the provision that is also applicable under Companies Act, that when you're issuing shares which are convertible or any security which is convertible, the pricing or the conversion mechanism is already decided. And when you're valuing those in securities, then you take into consideration that conversion mechanism to find the value of the shares. That is how you do it. And with respect to computing a value for the option itself, that is something that is done using option pricing models.
One another question we have: how investment in shares by government company in wholly owned subsidiary is valued?
Valuation by government in wholly owned companies, why will we value that? Because my understanding is that in case we talk about income tax, there is a exemption on this fresh issue of shares. Let's say that a government company is raising preferential issue or conducting a preferential issue for the purpose of, and we need a valuation under Companies Act. There, in case the government is allotting shares to the government itself, it might just go with the rights issue. But in case it is doing a preferential issue, then the valuation will again be done using the various methodologies that are available. So in case we talk about valuation methodologies per se that are allowed under Companies Act, it is not restricted to DCF. One can do a market comparison method, one can do a cost approach and an income approach, depending on what is the best suitable valuation method with respect to that company, with respect to that circumstance of the company. There can be a government company which only has a land and building asset, does not have any going concern. In that case, the value of the securities of that company will be directly linked to or coming in from the value of that land and building. So maybe there will be no going concern valuation, no DCF, only the value of that land and building will be considered in the valuation. So I will now.
One more question we have.
Ahead,
How
please.
does a company balance between the valuation requirements under FEMA, where the allotment should be more than the valuation, and tax requirement, where the allotment should be for less than the valuation?
So, as I said, there is a possibility that, let's say, a company is doing some capital restructuring, and there is a possibility that the company wants to, let's say, wants to transfer some shares first, and then after transferring the shares, or it wants to transfer the shares as well as issue fresh shares to another investor. There's a possibility that this kind of a structure happens, this kind of a transaction happens. In that case, one has to understand all the rules put together. So Income Tax Act will say that the transfer of shares from one person to the other should happen at least at a value which is the adjusted book value method, right? There is no DCF there is no other requirement there. So in that case, you compute that value, and then that value is a reference point for you that, okay, this is one value at which the Income Tax Act will not require any taxation to a taxation implication on the transferee or the transferor. Then when you look at FEMA says that in case you're transferring shares between a resident and a non-resident, then again the valuation will happen, and the value of the shares will have to be, or the transfer value should be such that in case a foreign investor is buying shares of a resident investor, then the value that he's giving should be more than that value that is arrived at using the valuation report. In case it is the other way around, then it should be lesser. It should not be more than the value. It should be equal to the value. So this is the provision with respect to transfer of shares. When we talk about issue of shares, FEMA does not differentiate between transfer of shares and fresh issue of shares, and therefore there is no problem. But Income Tax Act can say that in case you are issuing fresh shares from the company and you are getting more than what you valued the share as, then I want to tax it. So therefore, I said that there will be certain circumstances when you will have to pay tax to the income tax department, because the valuation report is giving you a value which is lesser than the actual consideration or actual value at which the shares are being allotted for the purpose of compliance with FEMA or Companies Act.
So we have only these questions, and
So I will try and talk about some recent case laws on 5627B. That is something that I thought I can talk about. And I will just share my screen and talk about some recent case laws, interpretations of those. I think that will help us understand this provision or this animal better. And
Yeah.
let me then, I have not organized this, but I think I will be able to share my screen and then maybe share my screen with all so that I can talk about this. Just give me a second, please. So let's go through these a few judgments for 5627B because I think that's our subject and for today, and it will also be a good review of the recent case laws that have been happening around. So this is from Chandigarh Tribunal, a very recent case law as recent as 24th February 2023, where it says that where assessee company determined value of shares issued at a premium on basis of DCF method, the valuation method opted by assessee could not be challenged in view of statutory mandate of Rule 11 UA2, and principal commissioner could not involve revisionary proceedings by adopting NAV method, as same would be in direct contravention to provisions of explanation AI to section 5627B read with Rule 11 UA. Then it says that where principal commissioner invoked revisionary proceedings on ground that assessee claimed TDS on interest income, so that's a different matter. So here again, they have uh, reiterated that this is the view that the income tax department has no business uh, to deal with 11 UA sub rule 2, that when the valuation is done, it is done. Then whether assessee company issued cumulative preference shares at premium, since assessee had produced valuation report before commissioner appeals in compliance with relevant provisions justifying amount of premium charged by it on issue of shares, addition made under section 5627B by AO on account of difference between FMV and share premium received by assessee was to be deleted. So again, something where the valuation report was given and therefore this kind of judgment came in. This one is January 2023, and this is in the High Court, and it says that this is with respect to income tax refund. It is not with respect to 5627B. This is Delhi Tribunal. This is in case of Sagittarius Securities versus the ITO. Here it says that where assessee company issued shares to two companies in consideration of 60,000 shares received from two companies and submitted valuation report for the said shares as per Rule 11 UA. Since certificate of auditors was based on statement and documents furnished by company which was neither audited nor certified by auditors, said valuation report was rightly rejected by assessing officer, and thus computation of fair market value of shares by AO on the basis of audited balance sheet drawn up on date immediately preceding valuation date could not be faulted with. So here what happens is that this is an example of uh, basically uh, 60,000 shares received from two companies. So here this is not with respect to fresh issue of shares, but this is actually with respect to the transfer of existing shares and the interpretation of Rule 11 UA with that respect. So whenever shares are being transferred and we are getting any assessment done, we need to make it a point that we are looking at the latest balance sheet. We need to take care of that. So here it says that where specific queries were raised by assessing officer during scrutiny assessment with respect to shares issued at premium by assessee company to a non-resident company, and assessee in reply had duly furnished information in form of names, PAN number, confirmations and ITRs of persons from whom premium was received, method applied, valuation certificates under FEMA regulations, etc., impugned reopening of assessment based on same set of facts and without any new material or information on record to take a different view was liable to be quashed. So this is a Gujarat High Court judgment. Uh, this is what we can do when we talk about income tax requirement, income tax compliances with respect to FEMA regulations. Look at the kind of judgments and look at the kind of litigation that is happening around this issue. So, as I was saying, that it's such a waste of everyone's resources that if an investor is coming in making investment in a company and we are saying that no, you pay tax on that differential, and we will understand the value. We will have a better understanding of the value as compared to the person who is paying the value itself. Where in valuation report prepared by CA, fair market value of equity share and preference share of assessee had been arrived at mainly after considering net worth of two step-down subsidiaries. However, fact of acquiring wholly owned subsidiaries, step-down subsidiaries after cutoff of valuation of shares was not provided to CA. Result arrived at in valuation report could not be accepted. So it's a Kolkata judgment, an ITAT judgment. So this is where what happens is that in case the CA gave a valuation, there was a valuation report, and there's a major event or major change after that valuation report. Then saying that yes, that judgment is not the valuation is not right is common. So as I said, it is very, very important that when we do the evaluation for compliance under Income Tax Act, we must make sure that most of the projected financial statements or whatever we are projecting is close to reality. Here again, where pursuant to a sale agreement dated 29/3/2011, assessee purchased certain property since transfer or receipt of property under reference took place in financial year 2014-15 on substantial compliance of agreement dated 29/3/2011. Commissioner rightly held that agreement in question was a valid agreement in law for the purposes of section 5627B, and it was within this revisional power to direct AO to inquire if agreement dated 29/3/2011 qualified to be an agreement referred to in proviso to 5627B. It's ITT Jabalpur judgment. I think they are talking about agreement with respect to property. So I believe that it is talking about the land and building part of 5627B, where in case you have an agreement to sell from an earlier date, then you can refer to that value. Here again, we talk about 5627B. So let's look at the summary here. So it's a Mumbai ITAT judgment, where assessee purchased 3 plots of land at lower price than determined by DVOs. Again, 5627B, then it says was not applicable. Provisions were not applicable. Then the assessee purchased 3 plots of land. So again here, lastly it says that uh, uh, so basically they did an addition under 5627B, and there again the DVO was involved in certain properties, so not concerning valuation of shares in my opinion. So where assessing officer, okay, Chennai ITT judgment, where assessing officer rejected DCF method used by assessee for valuation of shares issued on premium for reason of inconsistency in projected and actual financials and adopted NAV method instead. Since assessee had justified premium charged on issuance of shares And further, there was a minor difference in projected and actual financials. Impugn rejection of DCF method adopted by assessee was unjustified. So, what are the arguments here? Like, they relied upon the idea that there were only minor differences between the projected and actual financials. So, what I was saying that we should keep the projected financials closer to what we think is the future. So where AO failed to, this is a Bombay IT80 judgment, where AO uh, failed to take note of balance sheet as on valuation date. Additions made by AO had rightly been deleted as book value of liability shown in balance sheet has to be reduced for purpose of valuation and determination of FMV of unquoted equity shares. This is another judgment which relates to Rule 11 UA, but maybe with respect to the formula that is being used under 56 and not otherwise. Bangalore ITT judgment. So where there was no fault in approach of assessee in considering guideline value of land and building arrived for fair value of equity preference shares that it would fetch in open market on valuation date and arriving at premium value for redemption of preference shares and thus addition made by TPO computing differential premium on the basis of book value of shares was not sustainable. This is again a judgment which is with respect to 56 interpretation of that. So change of opinion matter that the here in this case it was the Supreme Court of India where it says that High Court order that where assessee company in support of increase in its authorized share capital had produced evidences in form of details of share allotment, name and addresses of the parties from where share capital was received. So the Income Tax Office went to the Supreme Court of India and the Supreme Court of India dismissed that petition because the High Court had granted relief to the assessee with respect to the assessment, and they did not allow the assessment to be opened or reopened, so that they dismissed. Two 2022 judgment, IT80 Ahmedabad, where assessing officer invoked provisions of section 5627B by dismissing valuation report of fair market value of equity shares issued by SSC company at a premium simply for reason that it was not as per rule prescribed under 11 UA. Since provision of section 5627B did not prescribe only one method of valuation of FMV of shares, and assessee could also justify FMV of its shares based on valuation of its assets as out of date, as on date out of, as on the date of issue of shares. Matter was to be remanded back to the AO to consider valuation report of assessee in light of provisions of law and thereafter decide issue of fresh. So went back to the AO in this matter. Kolkata Tribunal judgment says where assessee converted compulsorily convertible debentures into equity shares in relevant assessment year and claimed that entire consideration was received at the time of issuance of CCDs, then subsequent conversion entailed receipt of certain consideration by assessee in form of discharge of interest obligation, etc., Section 5627B could be applicable in instant case, as said section envisages wider outlook to receipt of any consideration which could not be limited to receipt of money. 5627B would not be applicable in respect of share premium amount received from non-resident angel investors for issuance of equity shares. Then it says where assessee adopted adopted DCF method for valuation of equity shares, assessing officer was not empowered to disregard DCF valuation as carried out by valuer, and such action of rejecting valuation report and hereby making an addition under section 5627B could not be upheld. So these were the arguments here. In order to apply provisions of section 5627B for any previous year, there must be allotment of equity shares, and such allotment should be over and above face value of such equity shares, where allotment of shares by assessee was complete in previous assessment year, then when provision of 5627B was not in statute books. Said provision could not be invoked to tax balance share premium received by assessee during. So it is at the allotment of shares. In case you have an allotment of share where you are getting set some part of the total value of shares at a later date through a call, then 5627B was not applicable. This was also a matter which was stuck between 2 years. So, where assessee, a joint venture company formed by a resident company and a non-resident company, issued shares to non-resident shareholders at a higher amount than to resident shareholders, in view of fact that project cost of assessee has to be funded in ratio of 40% by non-resident and 60% by resident entities, such valuation of shares was justified, and thus order of AO rejecting such valuation of shares by assessee was to be set aside. So interesting judgment, Delhi Tribunal judgment in the case of Myas India Medical Services, that in case you have two different valuations for this specific purpose, like this kind of an agreement between a joint venture company, then you can actually have a situation where you offer a differential amount to a resident shareholder versus a non-resident shareholder. So there the argument must be from the AO that if you have issued shares at a higher value to a non-resident company, then I will use the same value for the purpose of computing taxation under 5627B for allotment done to resident shareholders, right? So I believe that gives a brief about the recent cases and how this valuation under income tax is very, very important. Let's just take this last case. It's a High Court of Bombay matter. Says where assessment was sought to be reopened in case of assessee on ground that assessee had issued shares at excess premium, which was required to be added to assessee's income under 5627B. However, very issue of share premium was a subject matter of consideration by AO during original assessment proceedings, and assessee had provided working of fair value of equity shares as per Rule 11 UA. Reopening of assessment being a mere change of opinion was not justified. So this is how this writ petition was finished. So this is an optionally so these are optionally fully convertible debentures which were talked about, and here again 5627B it was basically talked about, and so it says that basically they kind of accepted the judgment here. So I will just quickly talk about other issue of shares. There can be an issue of shares which is also a matter of discussion with respect to ESOPs. So looking at section 17(2) clause 6 of Income Tax Act, we can understand what is the value. So the section 17(2)(7) talks about taxability of perquisites to employees, and it says the value of any specified security or sweat equity shares allotted or transferred directly or indirectly by employer or former employer free of cost at a concessional rate to the assessee would be taxable. And for that purpose, it says specified security means security which is defined under the section 281, and says that where employee stock option has been granted under any plan or scheme, so that is specified security. Sweat equity shares means equity shares issued by a company to the employees or directors at a discount or for consideration other than cash, or providing know-how or making available rights. Then the value of any specified security or rights uh, uh, shall be the fair market value of the specified security, and that's what is talked about. And then when you talk about what is fair market value, it goes to the prescribed method, and then we go to rules to understand that, and option and all that is of course talked about here in this. When we read rule 11, rule 3.8, 3.8 then talks about that for the purpose of subclause 6 of clause 2 of section 17, the fair market value of any specified security or sweat equity share being an equity share in company on the date on which the option is exercised by employee shall be determined in accordance with clauses 2 and 3. What does 2 say? 2 says that in case where on the date of exercising the option, the share of the company is listed, then it simply says that you go through the listing price or the listed value and then compute a value. Lastly, it says that in case where on the date of exercise of the option, the share in the company is not listed on a recognized stock exchange, the fair market value shall be the value of the share in the company as determined by a merchant banker on the specified date. Then, for the purpose of that sub rule, you talk about closing balance, merchant banker, where you talk about category 1 merchant banker, opening balance, recognized stock exchange, and so on. And the specified date, it says, is the date of exercising of the option. So the valuation for an unlisted company, and then it allows the earlier date of up to 180 days. So there might be a requirement that for a company which is unlisted and which is continuously offering ESOPs to its employees, they might be required to get a valuation certificate from an employer almost every 180 days to comply with this provision and compute the perquisite for that employee. This is something that would become a requirement under these provisions. So then it says that wherever the security is not an equity share, then again the merchant banker will compute that value. So this Companies Act again refers to merchant banker for this purpose. Unfortunately, as a chartered accountant, we cannot do that job. So that's my presentation, and I think I tried to cover all the aspects under various acts, regulatory requirements for issue of shares. If there are any questions that I can take, I'll be happy to do that.
We have one question. If
Yes,
valuation is required under multiple acts, which act of valuation will be taken into consideration?
So, as I said earlier, that in case the valuation is required under Companies Act, you have to have a valuation from a registered valuer. In case the same transaction requires a valuation under FEMA, then you will have to have a valuation report which is compliant with FEMA. So, in many occasions, what is happening is that, let's say FEMA is applicable, income tax is not applicable on that transaction, and Companies Act valuation requirement is there. So you might go to a valuer who is a registered valuer as well as a chartered accountant, and then get a valuation done for both FEMA and the Companies Act. In case you feel that no, this is an equity share allotment and you need a valuation under Companies Act, then of course you will have to get two different valuation reports, where Companies Act will require you to get a report from the registered valuer. The merchant banker valuation report will also be required for the purpose of compliance with Income Tax Act. So you will have to get two valuation reports. The two valuation reports might have a small difference in the value, but maybe you can try and kind of get some common assumptions made, use common projected data for both the valuation reports. That is the clutter that has been created right now, which is something that I think should change over time.
And another question we have is a valuation report required under FEMA in case of transfer of shares by a resident to FOCC, who is required to report said transaction?
So in case there is a transfer of shares in this scenario, the reporting requirement falls on the company. The company is then required to report this transaction through an FCTRS. FCTRS is a requirement to be filed because whenever the shares will get transferred, the valuation or the burden of compliance will come on the company in case of any change in the shareholding, where the change is happening between a resident and a non-resident person.
Okay. So we have only these set of questions, and we have more questions also. So should I ask?
Please go ahead. I think we have a few minutes to take up these questions.
Okay, sure. Section 115 JB MAT specifically provides for exclusion of DTA and DTL while computing MAT. No similar provision is there in under Rule 11 UA. In such situation, cannot conclude that DTA, DTL should not be excluded. I think we have discussed on this issue earlier, no?
We
That
discussed it. Let me
yeah.
just open that part because see, 11 UA, when we talk about fresh issue of shares, especially there, the matter of issue is that normally this whole provision or this formula of calculation of the value of shares, which is prescribed under 11 UA Part B, does not come into consideration because it is not required to be taken into consideration. But let us go through that rule again and see in case we can find out. If we can if I can try and establish that where what reference I can make to say that this is something that is relevant. So here, in case you look at this now, you look at the formula here, which is prescribed under 11 UA sub rule 1 part B. And here, in case you look at the value or fair value of unquoted equity shares, you look at, of course, A, where we talk about value of all the books of assets, which are reduced by all this. So what does it say? It says you reduce it by, reduce the assets by the amount of any income tax paid, if any, less the amount of income tax refund claimed, if any. Then it says that any unamortized amount of deferred expenditure which does not represent the value of an asset. These two provisions, in my opinion, do uh, cover deferred tax asset. When we come to liabilities, again in liabilities, we say that any amount representing provision for taxation other than amount of income tax paid, if any, less the amount of income tax claimed as refund, if any, to the extent of the excess over the tax payable with reference to the book profits in accordance with laws applicable thereto. So this, in my opinion, covers DTL, but there can be this is a matter of this can be a matter of dispute. My thought process is that DTL and DTA would not be part of my net worth. They will be basically they will become part of my net worth. They will not be separately identifiable as liabilities. So any other question, Sheetalji, from anyone?
Yeah, we have one more question. Under income tax, company issuing at premium, do we need merchant banker or registered valuer?
In case the company is issuing equity shares, it is must that it has to be a merchant banker. In case it is issuing a convertible preference share or some other security, then it can be a chartered accountant as well.
Okay, one more question. where rights are issued by private limited company in the year of incorporation at face value, then is the valuation report required
Rights are issued by a private limited company
in
earlier.
the year of incorporation at face value?
So we're talking about rights in the form of a rights issue is the question. I need
Right
clarity
issue.
on the so
Right issue.
rights issue which is happening at a premium will be covered under the Income Tax Act, or 5627B does not differentiate between a private placement and the rights issue. Rights issue of, however, will not require a valuation under the Companies Act. Rights issue is also covered under the FEMA law. So therefore, even if the shares are issued at a rights issue is done in the year of incorporation, even then the FEMA and income tax provisions continue to apply.
Okay. Yeah, one another question was, I think it's related to this matter. Can a private limited company issue right shares on face value instead of FMV, whether Section 56 will be attracted? I think you have answered this question also.
Case we are issuing rights or making a rights issue at face value.
Instead of FMV. Yeah.
5627B gets attracted only if the shares are issued at a premium.
And one other question is how to check the value of different shares in balance sheet date at end of financial year.
Value of different shares at the end of financial year.
Balance sheet.
So if you have a balance sheet at the end of the year, now my question to you is that what is the purpose of computing that value that you're wanting to compute? So in case the purpose of computing the value at the end of the year is to determine a value at which the shares can be transferred by one person to the other, and you're talking about equity shares here, then the valuation will have to be done under 11 UA sub rule 1 and then part B thereof, where the formula is prescribed. In case it is not an equity share, then you will have to go to part C. In case then uh, we talk about Companies Act. So in case of Companies Act, the idea is that whenever you're doing a preferential issue, maybe you're doing a preferential issue on 1st April, and there you want to compute the values on 31st March, then you have to get a registered valuer certificate. The registered valuer certificate will most probably not rely on book value, but will rely on the going concern valuation of the company. Similarly, for FEMA, maybe you will not rely on book value, but you will rely on the going concern value or the DCF methodology approach. For Income Tax Act, the book value will be computed under 11 UA, Rule 11 UA.
Okay. Mm, should we ask a question more or should we end now? I think it's now, it
It's
was
almost
like
time.
two.
It's almost time. In case there is any question that you feel is different from the questions that we have already taken up, then we can take one more question maybe.
It's already connected to the point of private limited company. Yeah, I'm taking that question also. Just a second. What is the difference between preferential allotment and private placement while issue of further shares by a private limited company? In many cases, where a new private limited company is incorporated and proposes to issue shares to persons other than existing initial shareholders, getting a valuation report would be burdensome by the new company.
But it might be burdensome, but then the Companies Act says that in case you are issuing shares to other shareholders and using a preferential allotment or a private placement, whatever you call it, doesn't matter, doesn't make a difference. You are required to comply with this regulation, get a registered valuer certificate, and make sure that you are then complying with Companies Act, ensuring that the existing shareholders are not getting a raw deal out of that fresh issue. Uh, so in case at the same time there is an option to bypass this process, which we have witnessed in the past, where the company comes out with a rights issue. All the existing shareholders who are given that rights offer, uh, eh, they say no. Uh, they kind of relinquish their rights, and they say that no, they don't want to exercise that rights issue. In that process, the Companies Act says that the directors can then issue shares to a third party on the same terms and conditions. And using that provision, using a rights issue, one can then allot shares to a third party. We have seen this happening and this method being adopted in a few cases. One can always use this methodology to bypass the requirement of a valuation to avoid that financial burden. But yes, there are multiple schools of thought there, and some people say that abuse of this rights issue process and saying that the entire shareholding going to a new shareholder through this process is not a very correct approach. But it can be used.
So thank you so much, C. Ankit Goyalji, for giving this knowledgeable session, Valuation Manthan series, and be a part of this series. I think our viewers will be benefited from this, your knowledge.
Thank you so much, Sheetalji, and thank you for being part of this 2 hour journey with me and sharing all the questions that the today's participants had. And I think it is always good uh, uh, to be part of such a platform where the ideas are shared, thoughts are shared. Thank you for this opportunity again.
Thank you so
Thank you,
much.
everyone. Thank you,
Thank you, sir.
participants.
Thank you. Thank you very much, sir.
Thank you, Rahulji.